The narrative of perpetual growth is dead. Zillow has just confirmed what the mainstream media tried to suppress. 53% of homes across the United States have lost value in the last 12 months. This is not a statistical anomaly. It is the most significant devaluation event since the bottom of the 2012 crash. From the collapsing condo markets of Florida to the saturated suburbs of Texas, the equity millions of Americans believed was guaranteed is evaporating. Inventory has now breached 1.1 million units, and the Great Housing Reset is no longer a prediction. It is a mathematical certainty. The system is fracturing, and for the first time in a decade, the ground is shifting beneath your feet. The headline is stark, cold, and undeniable. Zillow has reported that 53% of all residential properties in the United States have lost value over the past year. This is not a localized correction. This is a systemic recalibration. We are currently witnessing the widest spread of home value decline since April 2012, the very trough of the great financial crisis. For the last 3 years, the narrative sold to the American public was one of invincibility. Real estate only goes up. Buy now or be priced out forever. But the data from late 2025 and early 2026 has shattered that illusion. The momentum has not just stalled, it has reversed. However, to understand the true nature of this downturn, we must dissect the numbers with clinical precision. This is not yet a foreclosure crisis, it is a valuation crisis. The market is vomiting up the excess liquidity it ingested during the pandemic. Adjusted for inflation, home prices in the U.S. today remain over 80% above their long-term 100-year average. This indicates that what we are seeing is not a destruction of fundamental value, but a mean reversion. The market is shedding the speculative froth that was created by artificially low interest rates and mass hysteria. Crucially, we must distinguish between paper losses and realized losses. The vast majority of homeowners are not writing checks to leave their homes. Data suggests that only about 4.1% of mortgaged homes are currently underwater, meaning the outstanding loan balance exceeds the property's current market value. The typical homeowner, who has held their asset for 8 years or more, is still sitting on a mountain of accumulated equity, with gains averaging 67% over that period. But markets are not driven solely by solvency. They are driven by psychology, and the psychological toll of this devaluation is beginning to manifest. When a homeowner checks their Zestimate and sees their net worth decline by $50,000 in 12 months, their behavior changes. The wealth effect reverses. Confidence turns into caution. Sellers who were holding out for 2022 prices are now being forced to confront the reality of 2026 buyers. This is why we are seeing a surge in price cuts across the country. The paper loss becomes a realized reality the moment a for sale sign goes up. The pain, however, is not distributed equally. We are witnessing a violent geographic bifurcation of the U.S. housing market. On one side, we have the safe zones, the boring, unglamorous markets of the Northeast and the Midwest. Cities like Hartford, Rochester, and Milwaukee are still recording value growth. These areas never experienced the manic highs of the pandemic boom, and thus, they are spared the lows of the bust. Their affordability provides a floor. On the other side, we have the correction zones, the Sun Belt and the West Coast. These are the markets that defied gravity, and now gravity is taking its revenge. The data is devastating for recent entrants in these regions. In Denver, Colorado, 90.6% of homes have lost value year over year. In Austin, Texas, the figure is 89.5%, with average values down 11% from the peak. Sacramento, Phoenix, San Francisco. These metropolises are seeing value destruction on a scale that forces a complete reassessment of the buy and hold strategy. Furthermore, the correction is attacking specific asset classes with greater ferocity. The single-family home, the bedrock of the American dream, is relatively resilient, showing a flat or slightly positive trajectory nationally. But the condo market is bleeding out. Nationally, condo values are down 1.5%. But in Florida, the condo market has collapsed by 9.9% in a single year. This is the sharpest decline since the housing bust of 2009. While single-family homes in Florida are down a manageable 4.9%, the condo sector is facing an existential threat. This is not just a function of high interest rates, it is a structural failure involving insurance, regulation, and the physical decay of aging infrastructure. A perfect storm we will investigate in the next segment. The National Association of Realtors wants you to believe that the worst is over. They predict a bounce back. They predict growth. But the charts do not lie. The trend lines in the most speculative markets are pointing down. The era of free money is over. The valuation mirage is fading, revealing the harsh desert of reality beneath. If part 1 was the diagnosis of the symptoms, part 2 is the autopsy of the disease. The 53% devaluation figure is not a random occurrence. It is the result of specific structural fractures that have broken open the foundation of the American housing market. These fractures are not theoretical. They are legal, financial, and physical. And nowhere are they more visible and more lethal than in the state of Florida. Florida is currently ground zero for a housing crisis that is entirely distinct from the rest of the nation. It is facing a perfect storm that has nothing to do with the Federal Reserve and everything to do with the physical decay of its infrastructure. The catalyst was the collapse of the Champlain Towers South in Surfside in 2021. In response, the state passed Senate Bill 4D, SB 4D. This legislation, while well-intentioned for safety, has become a financial guillotine for condo owners. The law mandates strict milestone inspections for buildings 3 stories or higher that are 30 years old, or 25 years if they are within 3 miles of the coast. The deadline for completing these initial inspections passed on December 31st, 2025. The results are now coming in, and they are catastrophic. Decades of deferred maintenance are being exposed, but the true killer is the financial provision. Historically, condo associations in Florida could vote to waive their reserve funding to keep HOA fees low. SB 4D has outlawed this practice. By January 1, 2026, all structural integrity reserves must be fully funded. The result is a liquidity crisis of massive proportions. Associations are slapping homeowners with special assessments, emergency bills that can range from tens of thousands to over $100,000 per unit. For the retiree on a fixed income, this is an eviction notice by another name. They cannot pay. They are forced to sell. This panicked exit has flooded the market. In Cape Coral, active inventory has exploded to 12,395 units, creating a massive 7.9-month supply overhang. This is no longer a market. It is a liquidation sale. In Punta Gorda, condo values have cratered by 18.6% in a single year. In Cape Coral, they are down 14.2%. Buyers are fleeing. They are looking at the cheap listing prices, then looking at the HOA fees and the looming special assessments, and they are walking away. They understand what the sellers are trying to deny. You are not buying a retirement home. You are buying a liability. While Florida drowns in regulation and insurance costs, the Sunbelt states of Texas and Tennessee are suffocating under a different weight. Simple, brutal oversupply. Austin, Texas was the poster child of the pandemic boom. It was the city everyone moved to. It was the city where investors believed prices could only go up. Today, Austin is the cautionary tale of the bust. The construction pipeline filled to capacity during the zero interest rate era has finally burst open. Developers who broke ground in 2022 are delivering units into a 2026 market that does not want them. The numbers are staggering. Active inventory in Austin has surged to 13,290 homes, a 20.1% increase year over year. To move this metal, institutional builders are engaging in a price war. They are offering aggressive rate buydowns, subsidizing mortgage rates down to 5.5% to lure buyers. This tactic has decimated the resale market. An individual homeowner cannot offer a rate buydown. To compete with the builders, they must slash their listing price, and they are. 56% of all listings in Austin have undergone a price cut. The investor class that swarmed Austin is now rushing for the exits. They are finding that the rental math no longer works. Rents in Austin have fallen 6.6%, while property taxes and insurance have climbed. The negative cash flow is bleeding them dry. Tennessee is mirroring this collapse. Inventory across the state is holding at 50% above its long-term average for this time of year. In Nashville alone, inventory is up 15% compared to late 2023. The Zoom towns that thrived on remote work migration are now seeing the tide go out, leaving a glut of overpriced empty homes on the shore. This is the reality of the structural fracture. In the Southeast, the buildings are physically failing. In the Southwest, the financial model is failing. In both cases, the result is the same: a massive accumulation of inventory that simply cannot be absorbed by the current level of demand. The lock-in effect, the idea that people would never sell their homes because they wanted to keep their 3% mortgage rates, was the primary thesis for the soft landing narrative. Experts claimed inventory would remain tight forever. They were wrong. The lock-in effect is breaking. Life does not pause for interest rates. People get divorced, people die, people lose jobs, and now, as we will see in the next section, the floodgates are opening and the inventory trap is snapping shut. For 3 years, the housing market has been suspended in a state of artificial scarcity. Real estate bulls have clung to a single desperate thesis: the lock-in effect. They argued that because millions of Americans hold mortgage rates under 4%, they would never sell. They claimed inventory would remain perpetually low, forcing prices to remain perpetually high. That thesis has now been invalidated by reality. The dam has broken. According to the latest data from Realtor.com, active listings on the U.S. housing market have surged past 1.1 million units. We have witnessed a 15% year-over-year increase in inventory. We are no longer operating in a shortage. We have returned to the highest level of listings since 2019. We are back to pre-pandemic inventory levels. But this return to normal supply is happening in a macroeconomic environment that is anything but normal. In 2019, mortgage rates were manageable. Today, they are suffocating. The lock-in effect is thawing, not because rates have dropped, but because life cannot be paused indefinitely. We are seeing a thawing effect across major metros, driving new listings up by 15-20%. The pressure of life events, marriage, divorce, death, job relocation, is finally overpowering the financial incentive to hold on to a cheap mortgage. Households that held on for 3 years can simply no longer wait. They are listing their homes, and they are listing them into a void. While supply has roared back to 2019 levels, demand has been obliterated. Mortgage purchase applications, the real-time pulse of buyer intent, are languishing at 30% below the pre-pandemic average. This is the trap. Inventory is rising vertically while demand is flatlining horizontally. This divergence is creating a massive accumulation of months of supply. The more this supply builds, the more desperate sellers become. The power dynamic has shifted violently. Buyers are no longer desperate. They are ruthless. They are staging a capital strike. The cancellation rate for home contracts spiked to 15% at the end of 2025. Buyers are walking away at the slightest sign of trouble. They are demanding repairs. They are demanding price cuts. And if they don't get them, they are exiting the deal. Why? Because the alternative to buying has never been more attractive. The rental market, once a driver of inflation, has now become a deflationary force. For the first time in years, rent prices are falling across major markets. In Austin, rents have collapsed by 6.6%. In Phoenix, they are down 4.3%. In Jacksonville, Florida, condo rents have plummeted by 19%. This deflation changes the fundamental calculus of the American dream. In many markets, the monthly cost to own a home is now 30% to 50% higher than the cost to rent the exact same property. Why would a rational economic actor catch a falling knife? Why would a first-time home buyer stretch their finances to the breaking point to buy a home in a declining market when they can rent a luxury apartment for half the price with zero liability? They wouldn't, and they aren't. This creates a feedback loop of destruction. Investors seeing rents fall and vacancies rise stop buying. They turn into net sellers. This adds even more inventory to the pile. Regular homeowners, seeing their zestimates drop and their neighbors' homes sit unsold for months, start to panic. They cut their prices. The market has moved from a state of fear of missing out, FOMO, to a state of fear of buying top. The inertia has been removed. The inventory flood is here, and the buyers have retreated to higher ground. As we look toward 2026, the question is no longer, will prices drop? The question is, how does the industry establishment attempt to spin this disaster? And how can you navigate the chaos without becoming collateral damage? The housing industry is an optimism machine. It is designed to manufacture hope, even when the assembly line is broken. As we stare down the barrel of 2026, the National Association of Realtors is once again cranking the gears of that machine. The NAR is currently predicting a miraculous bounce back. They are forecasting double-digit growth in home sales and a 4% rise in prices for 2026. They claim that home prices nationwide are in no danger of declining. They argue that a slight dip in interest rates will magically unlock a tidal wave of pent-up demand. Do not be seduced by this narrative. We have heard this song before, and it ends in a funeral dirge. Rewind to January 2007. The housing market was already cracking. Yet, the National Association of Realtors released a statement pegging the fourth quarter of 2006 as the trough of the slump. They explicitly forecast that sales would gradually rise through 2007 and 2008. They told the American public the downturn was over right before the global financial system melted down. The NAR is a trade association. Their members are realtors. Realtors only get paid when a house sells. Their forecast is not an analysis, it is a marketing brochure. The reality of 2026 will not be a boom. It will be what Redfin and Zillow have more accurately termed the Great Housing Reset. This reset is not a V-shaped recovery. It is a long, grinding period of stagnation. The consensus among serious economists is that the era of 3% mortgage rates is dead and buried. The new normal for the 30-year fixed rate will likely stabilize between 6.0% and 6.4% throughout 2026. This rate is high enough to cap appreciation, yet low enough to keep the market on life support. In this environment, home prices will not skyrocket. Zillow and Redfin predict prices will remain flat or inch up by a negligible 1% to 1.7%. This is a market in paralysis, waiting for income growth to slowly, painfully catch up to asset prices. But for you, the individual navigating this minefield, macroeconomics are irrelevant. What matters is leverage. And for the first time in a decade, the leverage has shifted to you. 2026 is unequivocally the year of the buyer. The shortage is over, the power dynamic has inverted. If you are entering this market, you must abandon the mindset of the past 3 years. Do not bid over asking. Do not waive inspections. Those days are gone. Negotiate with ruthlessness. If you are looking at a property in Austin where inventory is up 20%, or in Tennessee where supply has exploded by 50%, you are the one holding the cards. Data from Reventure shows that in declining markets, price forecasts are signaling drops of another 4% to 10%. Use this. Print the report. Slam it on the table. Demand a price that reflects the future value, not the past delusion. However, a grave warning remains for those looking at the condo sector, particularly in Florida. This is not a dip. It is a value trap. A cheap listing price in a building facing a structural integrity deadline is not a bargain. It is a grenade with the pin pulled. You must verify the reserve funds. You must demand the structural reports. If you don't, you will inherit the previous owner's financial ruin. For sellers, the message is bleak but necessary. The window has closed. The test the market strategy is dead. If you are holding a distressed asset in a high-risk zone like a Florida coastal condo, waiting is not a strategy, it is gambling. Selling now, even at a loss, may be the only way to avoid the catastrophic special assessments looming in 2026. The 53% of homes losing value headline is not just a statistic, It is the bell tolling for the end of an era. The easy money is gone. The speculative fever has broken. We are entering a colder, harder reality. The housing market is returning to its fundamental purpose, shelter, not a casino. The Great Reset is here. Proceed with extreme caution. In a market defined by fragmentation, a generic strategy is a recipe for financial disaster. The rules of engagement have changed. To survive the great housing reset of 2026, you must adopt a tailored approach based on your position in the food chain. The days of rising tides lifting all boats are over. Now you must navigate the currents yourself. For the homebuyer, the year 2026 represents a restoration of sovereignty. You are no longer a beggar in a seller's market. You are the prize. Do not be passive. The cancellation rate is your leverage. Use it. Demand concessions that were unthinkable 2 years ago. Do not just negotiate the price, negotiate the structure of the deal. Demand that the seller cover your closing costs. Demand aggressive interest rate buy-downs to lower your monthly payment. However, vigilance is the price of entry. In the condo markets of Florida and the coast, a low price tag is often a trap door. You must audit the building's financials as rigorously as your own. Demand the Structural Integrity Reserve Studies, SIRS. If the reserve fund is empty, you are buying a debt, not an asset. Look to the markets where the bleeding is heaviest. Austin, San Antonio, Western Florida, where oversupply gives you the luxury of time and choice. For the home seller, the reality is harsh. The party is over. The strategy of testing the market with an aspirational price is dead. In a high-rate environment with rising inventory, an overpriced home does not get offers. It gets stigmatized. It becomes stale inventory, forcing deeper cuts later. You are now competing in a beauty contest where the judges are cash-strapped and picky. Buyers are sensitive to repair costs. Your home must be turnkey. If you are holding a high-risk asset, specifically an older condo in Florida, time is your enemy. The full impact of the special assessments has not yet fully materialized in listing prices. Selling now, even at a paper loss, may be the only way to preserve your remaining equity before the liquidity crisis deepens. For the investor, the calculus must be rebooted. The old models of passive appreciation are broken. With rents falling in key metros and insurance costs spiraling, thin margins will be wiped out. You must recalculate your cash flow projections with brutal honesty. However, chaos creates opportunity. The distress in the Florida condo market is not yet at its peak. As the panic accelerates into late 2026 and 2027, and as the structural deadlines force capitulation, a window for acquiring distressed assets at pennies on the dollar will open. But this is a game for those with deep liquidity and iron nerves. The market has ceased to be a single entity. It is now a collection of local crises and local opportunities. The 53% decline is the headline, but your survival depends on reading the fine print. The housing market of 2026 is not crashing in the way Hollywood movies depict. It is doing something far more painful. It is sobering up. The era of free money, 3% mortgages, and guaranteed 20% annual returns is a closed chapter of history. We have returned to the cold mechanics of supply, demand, income, and cost. The 53% of homes losing value is not a temporary blip. It is the signal of a new cycle. A cycle where cash is king, debt is dangerous, and data is the only shield you have against the storm. The system is resetting. The question is not whether the market will change. It already has. The question is whether you will change with it.